Maverick Traders. This is Rob Reinhold. I'm joined by Mr. Darren Fisher, and this is the trading room for the second week in August. Now, trading has been really good this summer, and August is typically one of those months that just drags on, but I think we might have some fireworks brewing for August. So let's get into it. In this session, we're going to cover the previous week. We're going to go through the news of the week. We're going to look at the broad markets. And we're going to take those stories into the next week and really boil down our current market analysis and see if we have a change in a score. And I'll just give it away right now. We do have a change in our overall market scores. We're going to break down the sectors one by one. We've got major changes in the sectors as well. And then we're always looking for new trading setups and opportunities. So let's go ahead and jump into it.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
All right, let's start with the last week's moves. So we did get a pullback. And both Darren and I, about a week and a half, 2 weeks ago, said, hey, you know what? We're up to the point where we probably should expect some pulling back. And we got a little bit of a pullback. We got more of a base out of the SP and the NASDAQ pullback. But then it looked like it was ready to bounce, and it got slapped down pretty hard this week. And the big news this week was that Tuesday after the market closed, Fitch downgraded the U.S. debt from AAA to AA. Now, this is only the second time this has happened. The first time is when S&P did it in 2011. It's not a great thing for the markets. It's not a great thing for the confidence in stuff like the US dollar and US treasuries. And they really pointed out that the reason they didn't like US debt going forward is that as our debt has increased and our interest rates have gone up, our debt servicing is going to become a lot more expensive. So it wasn't anything that I would say would kill the stock market rally, but it definitely took an overbought market. Remember, whenever the markets are flying high and they're a little overextended anyway, any little bad news like this typically just gives people excuses to take profits. Darren, what did you think about this Fitch downgrade?
I think it needed to happen, and I think they're entirely right. I got the biggest chuckle out of Yellen and other Treasury officials saying that the downgrade was unwarranted. Which brings us into a whole discussion of monetary policy. But no, I think Fitch did the right thing. And whether or not the Treasury liked it, that's up to them. I mean, but if that was if we're looking for, I think you're right. There was no reason for the markets to go down this week, but you get to that point, the markets are looking for an excuse to take profits and go down. I think that's what happened here this week. We found the excuse.
Yeah, totally agree. And I think another thing that happened this week was our 10-year bond yield went above 4%. And not just above 4%, we actually went all the way back to the highs in November 22. We're going to look at a chart on the 10-year bond, and you're going to see that there was a big change. We have clearly broken out to new highs on bonds recently, which again is not good for stocks. It is not good, especially tech stocks. It is not good for. We also had the first week of the month, and we always have manufacturing. So we had manufacturing ISM and the JOLTS on Monday. And if you take a look at these numbers, you can see that manufacturing was a little weaker than expected. JOLTS was a little weaker than expected. And that's really the theme this week, was everything was a little weaker than expected. We got Thursday ISM services PMI, a little bit weaker than expected. And then on Friday, we got the jobs report, 187,000. As you can see, a little weaker than expected. Now let's talk about where we are, because these numbers 2 months ago would have caused a massive rally because everyone would have said, oh, that means the Fed's going to be on hold and everything's great. We already now know that. So now weaker than expected economic numbers are no longer the good news that they were. Remember for how long we've been saying good news is bad news and bad news is good news? I think we've passed the point where bad news is good news. What do you think, Darren? You think that's the point?
Yeah, I think we've made about half the analysts and economists have made that shift, where good news is good news and bad news is bad news. But you've got the other half that are still in this flux of bad news is good and good news is bad. So I just think that it's kind of this in a churning before we get all the analysts and economists pushing the same direction. I think that's where we are right now. The one thing I do want to say is I think these regional manufacturing numbers that there was none this week, but I think the regionals are going to start playing a larger role in market outlook.
Oh, I totally agree. And you mentioned that the economists and analysts are on one side or the other. The market on Friday was on one side or the other. At one point, when this news came out, the market celebrated it, and the market recovered all the losses and actually was up about 1%. And then by the end of the day, it had lost it all and closed at the low. So the market is struggling with, is bad news now bad news, or is bad news still good news? I think the market doesn't know what to do either with it. All right, before we jump into the current market, let's take a look at some of last week's trade setups that we had. First one I want to talk about is Baidu. We had a Baidu long. It was breaking out of an area nicely, and it did not hold the breakout. Now, this is why at Maverick, we are so intent on calling the markets correctly, because this chart was really nice. And people say, well, geez, Rob, why didn't this go? Because the market pulled back. That's why. That's why. There wasn't anything wrong with the analysis. It was when the whole market sells off, it pulls everything down with it. So the question is it technically broken? Is this trade that we still have a couple weeks on, is this a trade that we should dump and move on? And I think you can see we are at the bottom end of a trend line here. If it holds on, I think it's worth it. However, if we start to drop substantially, it is no longer worth it. It is time to bail on this one, unless you have predetermined you're going to hold till expiration, which I have on this one. So guess what? I will be doing nothing on this. But if you have any active position management, then I think you need to pick a point where you are going to move on this. Maybe the 50-period moving average would be a clear break of this downtrend line. So again, pick that point if you have active management and move on. We also had Caterpillar, really nice high base, and you can see nice run off of earnings. We really like this one. So this was a good trade we had last week. Yeah, it pulled back with the rest of the market, but take a look at where it is. It's still up substantially for the week, 6.1% for the week. And then in technology, we had a short on Ciena. And you can see Ciena didn't go down. We're still holding this support point. And we talked about this as a descending triangle. You don't know when descending triangles are going to drop. It's like when you drop a marble on a table. It bounces, and each bounce gets a little bit lower, and then finally it rolls off the end of the table. So we've got more time on this one. I think this is going to be a really nice trade. It sure was weak with the rest of the market. We had this one, Tech Camino, in the materials sector as a butterfly. And you can see it basically stuck in our range. However, our range, 44, I think 44.50 is where we want it to be. It is at the bottom end of our range. We do want this one to come up a little bit, but we still have a little bit more time. But this one still looks great on a sideways trade. And the sector that we loved the best last week, and it was the best sector, was energy. We said, hey, energy is really starting to pick up. And I said, for the first time this entire year, I am the most bullish in energy of any sector. And Range Resources had a great run this week, up almost 5% on the week. So this trade's looking really good at the moment. Let's jump into the markets and break down the numbers from last week. Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years, and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply. Dow Jones was down 1%. S&P down 2.2%. The Q is down 3%. That's where the most of the selling was. Take a look at the Russell. The Russell that has been the worst, now that the market is dropping, it's actually holding down the best. Oil with a nice gain, 2.5%. Again, it was a pullback week for sure in everything but energy. It was just one of those weeks where almost everything went down, but energy was the standout. Let's take a look at this chart. And I really want to focus on this candle that we got on Friday. Now, if you were to ask me, Friday at about, let's call it noon Eastern time. Noon Eastern time, this candle was at its high. It was a big, fat, green candle. We had climbed all the way back above the 20-day moving average. And at that point, I'm like, hey, if this closes here, then this is a beautiful bull pullback, and we should absolutely look to get more bullish. A couple of hours later, if you were to ask me my opinion, it is completely different here. This is a complete failure. The market should have bounced here. It should have bounced. It tried to bounce, and the selling was just overwhelming the buyers. And you can see we closed now down to our lows. We now have to start to think about, okay, maybe this pullback is going to be deeper because we got the pullback. It tried to rally, and it didn't happen. So it's just not ready yet. So here's the question. Where is it going to be ready? The next level I have here is about 444 on the Qs. This was the breakout point where we had some prior resistance. This looks like the next stop for these markets. And again, it's going to be the same thing. Can we get a candle that is a reversal candle? Can we get a hammer candle? Can we get a doji? Can we get a bullish engulfing? Some candle around this area that tells us, okay, the buyers are now back in control. The buyers are now larger than the sellers. This is the first line in the sand here. And then I'm going to go down to this 50-period moving average that probably at some point is going to be around 441, 442. These are very critical levels because if we don't hold these levels, remember, we have been at a +3 for months. We're now getting the first warning sign that there could be a change. It's just a warning sign. We still have bullish moving averages. We still have bullish price action, but we need to be cognizant that the change may be happening. A breakdown below 444 is going to be another strike, and a breakdown below the 50 is going to be the third strike. And at that point, we will be saying we are no longer bullish these markets. And our rule is if the markets are below the 50-day moving average, we are net bearish. Let's take a look at the NASDAQ. We really have the NASDAQ at the same place. But the NASDAQ is pulling back a little deeper. It blew past its 20-day moving average and just really never held it. So it's at support here. Ultimately, the 50-period moving average is going to be the last chance for this to bounce. Look, you never know when the trends are going to change. I can guess, Darren, you and I could sit down and have a drink together and pontificate about it, but we won't know until it happens. So at this point, you have to get more defensive, but it's too early to get bearish. What's your call, Darren?
Yeah, I'm with you. I mean, I'm turning my portfolio more neutral, and I'm giving my bulls a longer time horizon to play out. And the ones that I'm going short, I'm looking to be very short term with them, but a little bit more aggressive. This might be a period of time for the next week. You could get those $5 moves to the downside, whereas 2 weeks ago we were doing chicken bears. And for those of you who don't know what chicken bear is, it's usually just a bear call spread with about a $1 difference between the strikes. We're just playing theta and a little bit of delta. I think for the next week, we've got the opportunity to get some sharper moves to the downside. And I actually think that 50 is going, you're right, that is the line in the sand. And I think just for a healthy market, I think we have to touch it because we haven't touched that 50-period moving average in this whole chart that we're looking at. That's a good 4 months right there. So I would still be bullish if we touch that 50-period moving average. But you can be 2 candles below that 50, then yeah, I think we really have to reevaluate things. But we're by no means we're not there yet.
And I love what you said, 2 candles below that 50. And let me quantify what Darren means by that. It's very common to get these areas pierced. So what happens is it's going to come down and it's going to not bounce at this 50-day moving average. And there's going to be a big flush out to the downside that's going to last like a day or two. And then all of a sudden, 2 days later, it's back up above and everything's okay. That happens very regularly at 50-day moving averages. It's a big point and it's a flush out. It's a flush out to get the last people to panic and sell before the buyers come back in. So as Darren said, he likes to see 2 full red candles underneath that, basically saying, hey, we're not going to get that pierce short term and a bounce back up. That no, this is consistent selling for a couple days after the fact. I think that's exactly what you want to be looking for. And I did want to take a look at the 10-year bond just to point out the changes here. We'd had this 4% ceiling, 4.05 really, and you can see we took it out, and now we're up against November 2022 highs. If we go past this, if we go past 4.2, the market doesn't like that. The market is not going to like that whatsoever if we start to head higher here. So I think this is something that you also want to keep an eye on just in case. So let's talk about this week. The markets need to prove the bottom. This week is a week where we could, by Friday, have a more bearish tone and say, hey, we need to be more bearish than bullish for the first time in a while. We could. We're at that point. We're at that point. We have to get ready for it. But remember, this is still a bull market. And the way bull markets work is every so often, they're going to push people out and test people and get these deep pullbacks that freak people out. And then the uptrend resumes. We need technical proof, not our opinion, not how we feel. We need, as Darren said, a couple candles underneath that 50 MA to really prove that this up move is over. Because again, the market's really good at shaking people out in wild bull markets. This might be one of those. We need proof. Check the earnings calendar. And then look, we've had this August trading seasonality. I personally thought that August was going to be a slow grind higher. And then in September, as usual, we get a massive pullback. I don't know if the market has listened to me because it kind of looks like it wants to do it early this year. So I am no longer in the camp that this August is going to be a slow grind higher. I think this August is likely to have some volatility. So just be ready for that. This week, we have inflation news. It's all inflation this week. Inflation, CPI on Thursday, and then PPI on Friday. And that's really about it as far as economic reports go. We have been at a +3, and we backed off to a +2, and now here we are at a +1. So we are still bullish, but we have definitely dialed back the bullishness. We've been talking about that for the last week or two. Let's talk about this week. I'm with you, Darren. I think this week is going to be challenging, especially the first part of this week. I've got us at a -1.5. What do you think, Darren?
Yeah, 1.5. I mean, I think that might show some volatility in there. I mean, we might be down at -2.5 and then get a really good day Thursday or Friday and bring us up to that -1.5 type of thing. So I think that there's going to be some volatility in this, but this is going to be one of those ones where we need the market to prove that it wants to be bearish. This could bounce at any time and confirm, and then we just change our outlook again.
Yeah, no, very well said. All right, let's take us through some sectors, Darren.
Yeah, a lot of damage done in the sectors. You're going to see it. I mean, this is even more pronounced than in the broad markets. Let's take a look at that. Utilities down 4.5%. Tech was down 3.8. A lot of other stuff. Communication services, real estate, healthcare, all materials, all down too. So it was broad-based selling. What held out there the best? Energy obviously had the only gain. Consumer financial held in. But you're going to look at these charts and say, oh, some of these are looking pretty ugly. What was a +2 last week is now a 0, or what was a +1 is now a -2. There's a lot of shift in the technical analysis of these sectors. So let's take a look at them individually here. Probably what, as you can see, the worst performing one was utilities. we were at a +1 last week, and now we're firmly down at the -2 camp. Now, the only saving grace right now is that we're at support. So if this can bounce, then great. I think you could go with a -1 and just say we're going to base here. But if we break below this, you've got to go back months before you find any type of support again. So this could, I think this is tied directly to the rate in the 10 years. When you're using the dividends for utilities as a proxy for bonds, and the bonds get more attractive than the utility coupons, and then you're going to see them go down. So watch out for this one here coming in. We'll see if it bounces. Looking at communication services, nice orderly pullback to the 20. I'm still at a +2 on here. It really, didn't have, I'm not seeing any massive red candles this week. So we just came back a little bit, and that's fine. We're still at the 20, or above the 20, above the 50. I'm at a +2 for this one. Real estate, though, it ran hard and ran fast to the downside. Looks like it was trying to hold up there in that 0 range Monday, Tuesday, Wednesday. But then come Thursday and Friday, just a bunch of volatility. Despite that long lower shadow on Thursday, it couldn't get any type of momentum. Gave back all its gains plus minus another 1%. So I'm in a -2 for real estate. Industrials, it was at a +2. I'm now at a 0, right in between those two moving averages. We're at the very bottom end of that. We're creating a sideways channel right now. You'd still be bullish. This thing could pull back the 50-period moving average, and it could bounce between 106 and 110, and it would still be bullish, just basing to the sideways. So that's what we're looking at in industrials right now. Healthcare is another one that gave up a lot of gains. Came down. I guess you got one tiny green candle there on Wednesday. Everything else was red. So going from a +2 to a 0. A lot of people are. I think a lot of this is profit taking because 2 weeks ago healthcare was at yearly highs. So just bear that in mind. I think where the profit taking scenario that we talked about probably 6 weeks ago just came about a week later than what we had expected. Financials, again, just pulled right back to the 20-period moving average. Very orderly pullback. We're at a +2 here. If it looks like it wants to bounce. Now, look, give me a Monday and Tuesday's candle, and I could knock this down from +2 to 0 in that amount of time. So this has got to hold its gains right now and confirm with a higher high and a higher low, and then I think you could, then it's off to the races right now. Look at consumer, again, we were at a +1. It's just kind of basing right here. Despite the fact that we've got a red candle on Friday, with still a gain, it was still up 1.5%. So I'm going to call this right at the 20-period moving average. And we're just going to go with a +1 on this, very mildly bullish. But this, consumer held in very, very nicely. In tech, this is another one. Went down to from a +2 to a 0, right at the cusp. Does tech, break below that 50-period moving average and lead the market down, or does it bounce right here? It's kind of funny. You do this enough, you'll find that pullbacks to the 50-period moving average often coincide with previous, like a month ago, support areas right there. So you go back about a month, and you're right there at the same levels. It's kind of interesting how you see that the more that you do this right here. So if we get a bounce, then I think you go mildly bullish on tech. If it breaks down below, I think tech is going to be the leader to the downside. So this is the sector I'm going to be watching here the last half of the week and see which way it goes. Materials, we were at a +2, and again, nice early pullback, a little bit deeper than some other stuff. We closed just slightly below the 20-period moving average. Some went from a +2 down to a +1. Materials is still looking pretty good, though. And we're at a +2 on energy. I'm at a +2 on energy this week. It really looks in a nice high base right here, and a little bit of a down candle and a little bit of a red candle on Friday, but we still made a gain. You're still up for the day on what was a pretty ugly day on Friday. So looking at everything, Real estate and utilities, very interest rate sensitive sectors, are now down at a -2. Tech, healthcare, and industrials are just sitting right there at a 0, neither bullish nor bearish. They need to confirm one way or the other before we're going to put any decent capital behind them. Materials consumer mildly bullish at a +1, and what's looking still looking good, energy, financials, and communication services at a +2. So let's look at a couple of different trades here.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
In utilities, look at the Southern Company, and this broke down hard. You remember that the sector for utilities was right at support right there. Southern Company said, hold my beer and watch this. Broke down below 69 right there, confirmed on Friday. This is looking pretty good. How do you want to play this right there? I'm going to go out to the August 25th and do that 65-70 bear call spread. If you want to do a targeted butterfly, it's not quite as aggressive, you can go out to a butterfly with a 66 midpoint. At communication services, Warner Brothers Discovery. This is going to be to the upside. You can see that we had a nice long downtrend, and finally on Friday, an ugly day for the market, Warner Brothers broke above that trend line, and it did it decisively. So whenever I see a breakout among these trend lines right there, I like to do the diagonal calls. So I'm going to go out to September 1st and get that 12 strike, buy the 12 strike, and then I'm going to go out to next Friday, and I'm going to short the 1450 against it right there. Just saying, hey, give me another 50 cents in the next 5 days, which you could, and then you can decide what you want to do with it. But I like these first stage breakouts above these downtrend lines. I mean, this could be one that if you wanted to possibly go out to October even, I think you can run a series of diagonals on it, because this one's got some legs. Usually when they break out like this, they've got some legs.
Yeah, I really like this trade setup, Darren. Right, let's move into financials. So financials is one of the sectors that it just had an orderly pullback. So again, the market's being put under pressure, and we're seeing which sectors are holding in better, and financials is one of those that is holding in better. And here we have a stock, U.S. Bank, actually up on Friday, up on Thursday. I mean, this thing wants to go up regardless of what the market does. So a nice high base. How do you want to play it is the only question. Do you want to play it more aggressively? If so, then an August 25th, 39.42 bull call spread. If you want to be less aggressive, which I'm going to be doing, is the 38.41 diagonal call spread. Where again, we're just selling that 41 up here. Going to give us that nice risk graph to where we got a little bit of delta and a little bit of theta working for us. As long as it doesn't tank, this thing is going to be a really nice trade in U.S. Bank Corp. This is one of those banks that really got hit in March when we had all the banking problems. And it's coming back, and you can see it does not want to go down anymore. It is just refusing to go down. Anytime it goes up, it just refuses. So that's why I really like this one in the financial sector. Consumer also was really holding up nicely. When you take a look at, okay, where was the pain? The pain was clearly in interest rate sensitive and technology stocks. There are some places that are actually holding up well, and Consumer is one of them. Now, I talked about this on my Thursday end of day video, and I cannot tell you how badly I hate this store. I do not like Kohls. I hate it so much. But look, it doesn't matter what I feel about Kohls. I can still make a trade long on it. Now, I used to not be able to do that as a young trader. I used to not be able to like a company and go short the stock or hate a company and go long the stock. I couldn't do that because it was too interconnected. Now, I can hate on the company as much as I want, but this thing wants to go higher. Same thing. I mean, look at this. It got absolutely hammered until June, and now, other than this one deep pullback, it is refusing, absolutely refusing to go down. I mean, even if after run after run after run, it is just refusing to go down. I like these here. I like the diagonal call spreads here. Why? Because the market's a little dicey here. I don't want to get too far out over my skis, so I'm going to do a very conservative diagonal call spread. You could even do a 29 or a 29.50. I believe they have 50-cent strikes. Just to get in, see how it reacts. I can make a decision on Friday of whether or not I want to stay in the trade longer. That is Kohls in consumer.
So in technology here, we're looking at Juniper Networks. This is a nice little bear rally. It almost tried to confirm for us on Friday. We got that long upper shadow, a little bit of went right up to a resistance right there, but we still need that lower low and that lower high because this thing could float all the way up to 30, and I wouldn't want to make an entry till I get that confirmation. So again, how deep, how long do you want to play this? You just want to play it really short term, August 11th, 28-29. I'm probably going to go out to the 18th and do something a little deeper, down to the 27th. But wait for that confirmation.
All right, and still my favorite sector out there is energy. Energy is the one that's rocking right now, and this is Antero Resources, AR. We had a nice breakout. It ran. We had 4 or 5 days where it sat here, and then it broke out. Look, Friday's candle is not the greatest candle I've ever seen. And look, I know that this could pull back more, but if this sector keeps going, I actually want to be more bullish this sector. I rarely do straight calls. About 10% of my trades end up being straight calls. Everything else is a spread. I like this one on straight calls. If you're saying, Rob, that is a little too much for me, just do a bull call spread. Just dial it down a little bit to where it's not quite as aggressive and you have a little bit less theta working against you. But as you can see here, if this thing does take off, if the sector takes off, there's no reason why this thing can't make it up to 30 in the next couple of weeks. All right, those are the trades we have for you. Maverick Traders, if you have other trades you want to share, please go to the website. Go to the members area. Go onto the forum. We love to see all the discussions happening between our traders, helping everybody be more profitable. Wrapping this up, the market's on a cliff edge. Now look, one of two things happens. You go over the cliff, or you get really close to it, and you're fine, and you just forget about it in a couple weeks. That's where we are. So let's be realistic of where we are. Everyone have their portfolios in the right place to where if we do go over the cliff, you're not going to get killed. And if we do hold on and recover, we don't get killed there. I think this is a time to dial everything back and just wait and see what's going to happen. It's not a time to be a hero here. There's times to be heroes. We've been heroes in June and July. Those were fantastic months. August is not the month to be a hero. August is not the month where you're going to go out and try to put on 5-10% in your portfolio. August is a month that you're going to try to not lose, in my opinion. Darren, what do you think about that advice?
Yeah, sometimes that's if you wanted to go, if you don't like the market, what the market's doing, you want to stay in cash till September, you go ahead and do that. But I would still stay in. I would just be dialing back everything. Dial back the aggressiveness on everything, go to a more balanced allocation, and that I can add to on either side once the market makes a decision.
And as you broke down the sectors are telling the story here. The sectors are, look, you don't really need to know where the market's going to go because you could play those sectors. And if the market breaks down and you're playing the weak sectors, those are going to be good gains. And yeah, you might lose a little bit on your longs and vice versa. If we hold on and you're in the right sectors long, that's going to be a really nice trade. So really, the story is in the sectors. Focus on those. Thank you so much for joining us. Everyone have a great weekend. Goodbye, everybody.
Good trade, everyone.